So I want to share with you the five biggest differences between HELOCs and HECMs. And just so you know, a HELOC is a home equity line of credit, and a HECM is a home equity conversion mortgage. So before I get into all the details, I want to share you a quick story. So have you ever went to the bank to borrow some money? You walk in, you have to put your name in for an appointment. You have to sit there and you have to wait, getting a little nervous. You don't know what they're going to say. Even though you know you qualify, you always have that concern. Then you go back to the back. You get asked by the banker to grab a seat. The next thing you know, you look around. They've got their pictures. They've got multiple screens on their computer. They've got a tie on, very nice suit. And then you start to share with them what you'd like to do, how much money you would like, how you would like to apply for a loan against your house because you want to do some remodeling, some renovations, maybe you want to travel. And they just kind of nod their head, listen to your story. And once you're done, they tell you, all right, they pull out a list. Here is all the things, all the qualifications, all the boxes that we have to check to get you from where you are to where you want to go. And if we decide that you're worthy of this loan, then here's what the payment would be. Here's how often you'd have to make the payment. And you would have to make this number of payments or you would be in default. You follow me? So, rules, uh, basically, you'd be sitting down with a slick banker that's telling you what you can do, what you can't do. And hopefully, if you meet all these strict requirements, we'll give you the loan. And then you have to follow all the rules. Okay. So there's one that's a that's one side of the equation. Now the other side of the equation is, does everyone have a cool uncle? You know what I'm talking about? That cool uncle that calls you Bubby, that calls you you know, calls you stud, calls you, hey son, how you doing? Probably still gives you a high five, may even say man 12 times a sentence. What's up, man? That cool uncle. So think about if you had that cool uncle and they happen to be financially set, well off, have all the money they need, and they were cool. So think about going to ask your cool uncle that maybe if they're not, but if you add in wealthy cool uncle, what if you went and talked to them about getting a loan? How do you think that would go? Probably a little different than the banker. They may have a Hawaiian shirt on, they may have flip-flops, who knows? They may not even be wearing shoes. And it'd be very laid back. You tell them what you want, no problem, Bubby. I got you. Don't worry about it. Pay me back when you can. I know you're going to use it well. Either way, I want you to have the money because we know that you need it. Now, if you think about those two stark differences in asking for money or applying for a loan, that would be a layman's way of explaining the difference between a HECM and a HELOC. So I want to share with you five big differences, but maybe you can see which one's which as I go through those. So difference number one between HECMs, home equity conversions, and HELOCs would be credit score. Credit score. So to get a HELOC, which would be the strict, tough banker side of it, you're going to need 700 plus credit. You're going to need no recent late payments. You're going to need to pay all your bills on time. You're going to need to be on top of your P's and Q's with your credit score. Now, as far as the HECM, the home equity conversion, FHA's version of a reverse mortgage, you can have lower credit scores, you could have late payments, you could have collections and still possibly qualify. Just to give you an example, we had a lady that had no open lines of credit. The only thing she had open were collections. Her credit score was 426 credit score, and we got her closed and being able to give her money to work on her house to cover some back taxes, cover back insurance, and cover bills. So wide contrast between the HELOC, the slick banker, and the HECM, which would be your chill, laid back uncle. All right. The second difference, number two, would be debt to income ratio. So on a HELOC, they're going to take your income coming in, look at the payment on the HELOC, look at all your other bills, and it has to be probably about 30 to 40% after whatever the rate is, they're going to raise the rate by 2 points and re-amortize the loan and all. And they're going to be really strict on how much you can have coming in versus how much you have going out. On the HECM, the home equity conversion mortgage, they're going to be more lax because the required monthly payment is zero. So you don't have to make a payment. So that's going to automatically lower your debt to income ratio. So big difference between the slick banker, which is the HELOC, and the laid back uncle, which would be your HECM, home equity conversion mortgage. So easier on the debt to income ratio. So the third thing is going to be the third big difference would be monthly payment. Monthly payment. So on the HELOC, you're going to have a monthly payment required to be made every single month. Normally, if you miss 3 or 4 payments, then they're going to talk about default, talk about selling your home, things like that. Now, on the HECM, home equity conversion mortgage, you can make payments. Some people do make payments, but there's no monthly payment required. No payment required. So as you can see, big difference between the banker and your chill, laid back uncle. No payments required. You never have to make a payment. Some people do. You just don't have to. Only downside to that, as you could guess, there is interest. So the interest is just added to your balance. But that's why you have really, really low loan amounts and leave lots of equity in the home. But no payment required. So big difference between the banker and the uncle, the HELOC and the HECM. Makes sense? So that would be another difference. The fourth is going to be due date. The fourth is going to be due date. So what do you mean by that? Well, the home equity lines of credit are going to have a due date, an ending date. What do I mean by that? Well, usually either 5, 10, or 15 years into it, they're going to want their money back. So if you just make the interest only payments for, let's say, 10 years, you owe all that money. So if you borrow 100,000, you just pay the interest. In 10 years, they're going to send you a letter that says, we want our 100,000 back. And you have to deal with that. So if you're 62, you wake up at 72 and you still owe 100,000. On the HECM, a little different. There's no due date. There's no ending date. Well, sorry, let me change that. There actually is in the fine print, says your loan is due and payable if you make it to year 150. So if any of you are going to live to 150, then you got to worry about paying it back. If you don't, no worries. I don't even know why they put that in there, but it does say 150. So meaning that in 10 or 15 years on the HELOC, you have to pay that back. Either refinance it, pay off the house, those type of things. And then on the HECM, you never have to pay it back unless you live to 150 years old. So big stark difference there. The last thing we're going to talk about is availability of credit. So number 5, your loan could be frozen or closed, yes or no. So on the HELOC, unfortunately, most people don't know this. It's in the fine print. If the economy goes south, your equity goes south, the bank can send you a letter that says, I hate to tell you, you thought you had 100 grand available. Now you don't. It's closed. It's frozen. You can't get your hands on that money. On the HECM, it could never be closed. It can never be taken away from you. It's yours once you close the loan. So, Slick Banker on the HELOC, they could say, I know we told you this, but we changed our mind. On the HECM, you're cool, laid back uncle. They can never change their mind. They can never pull your money back. They can never freeze the money. It's yours. So do you have a pretty good grasp on the two between the HELOC, which is the slick banker with all the rules, and the HECM, which is your cool uncle, real laid back with their money? So the differences are number one, credit score, number two, debt to income ratio, number three, the monthly payment, number four, so my hands are not working correctly here, is the due date, means the loan can be called due or payable. And number five, it could be frozen. It could be frozen, taken away from you, and not have access to that money. So hopefully this shared a little bit of difference between the HELOC, the Slick Banker, and the HECM, the home equity conversion laid back uncle. If you would like to learn more about how we do this, please reach out to us. We'd love to share with you a case study, how it could work with you or work with your family's name, some of your family's birthday and age, and we could just run some case study and some numbers for you. Also, too, please feel free to share this with people that you know. Please feel free to subscribe. We love to add value and serve seniors. We have a heart for serving seniors, as you can tell. And we love what we do and want to get this message out to as many people as possible. So thanks again. Look forward to catching up with you soon. Have a great day.